Our benchmarks have been consistently hitting record highs in the last month. The decline in the daily caseload of COVID cases and states easing up on their business curbs has lifted the sentiments of all domestic and foreign investors. Investors too have flocked to the markets in a big way, especially equity funds and direct equities. According to Amphi data for May, net inflows, meaning investments minus the redemptions, have been rupees 10,000 crores. We must understand that there are always two things we usually see with the markets. They will go up and down in the short to medium term, and they will always go up in the long term. This strategy of selling or booking your profits and buying later at lower levels sounds like a great thing, but is so hard to identify entries and exits. This policy of buying and selling stock for a gain of 5 to 10% is not only tax inefficient but poses a very high risk of missing out on the big upside that is just a few quarters away. It is at this time most of the investors get rid of the good quality stocks with good fundamentals and replace them with low quality stocks and get stuck with them for longer periods of time. For example, this is typically the journey of an investor who is looking to capitalize on an alleged trend. They see a trend at the start and begin to watch the market. During the upward trend, they identify an entry point purely based on the fact that it had grown since they started monitoring it. Whenever there is a correction, they treat it as a minor bump. So when it corrects more than that, they usually use this opportunity to increase their exposure. As it continues to go in the downward trend, they monitor continuously and treat each low as the absolute bottom. Once it gets to a stage, they are vexed with the stock and sell all their holdings in the fear of losing out more. When it falls even more, they feel they have outsmarted the market by getting out early. It is here that the trend usually reverses and the stock starts its growth. They are confused, but again, afraid to lose out, so they end up buying again at the same time that they had bought previously. Just imagine the emotional stress in such a situation. Trying to time the market will consume a whole lot of your productive time, which can be best used on other important stuff. Apart from the potential capital erosion you will see, you will also incur a high transaction cost. So we tell all of our investors the same thing. Don't place undue importance to entry point in the market. If you are picking undervalued companies, they will always have a scope to grow from their current levels. Remember to pick fundamentally strong and growing companies though. We at Vivekam will not only choose undervalued and fundamentally strong companies, but also split investment into different tranches to get rid of any entry time bias in the markets. Make sure to try something like this in your investments. Make sure to not indulge in short term trading and invest wisely. Thank you.